Hi, I'm Jimmy. In this video, we're going back to the inverted yield curve. We're looking at what the inverted yield curve has done lately and what it can tell us about the economy. So a few months back, the inverted yield curve was dominating the headlines. Yet most recently, it seems that the headlines have been dominated by the lowering of interest rates by the Federal Reserve, or the possibility of lowering interest rates by the Federal Reserve. To illustrate, this is a chart of the S&P 500 since the start of last month. And as we could see, it was trending lower on news about trade wars mostly. And then, the start of this month, well, it started heading higher once it came out that there was a possibility that the Federal Reserve might lower interest rates. Then the market reacted by driving things higher. Now, on one hand, that's actually somewhat logical, since lower interest rates does lead to higher stock valuations, and in theory, higher stock valuations should lead to a higher stock market. We did a video on this exact topic after Warren Buffett came out and said that if interest rates stay low, well, then the stock market may be cheap. You can see a link in the description below to that video. But generally, the Federal Reserve would only lower interest rates if they were trying to spur the economy. So them coming out now and saying that they may cut interest rates would imply, at least to me, that they may be losing confidence in the economy's ability to keep pushing forward, which is sort of the opposite of what I assumed that they felt back when they were raising interest rates. Now, I'm sure that there are some people saying how bad things are for the US economy, or we're already in a recession, or we're about to fall off a cliff, or whatever it might be. And I suppose we can all define a recession however we like. But the technical definition that the Federal Reserve uses for the definition of a recession is 2 consecutive quarters of negative growth in GDP. So this chart here of GDP, as we can see, growth has been at least okay up until this point. But clearly the Fed is worried about something if they're already talking about lowering interest rates so soon after they were just raising them. So let's look at what happened, and then we can see if we can come up with something for the future of the economy. So recently I did a video on the inverted yield curve, looked at the basics of it, and then we analyzed some historical recessions and tried to look at what the inverted yield curve looked like before those recessions. If you're curious, you can find a link to that video in the description below. But ultimately, to summarize that video, what makes the inverted yield curve important is its ability to predict recessions. And as I pointed out in the last video, all recent recessions have been preceded by an inverted yield curve. But not all inverted yield curves have led to recessions. So basically, that means that sometimes we get an inverted yield curve and we don't get a recession, but we've never had a recession that wasn't preceded by an inverted yield curve. So what exactly is an inverted yield curve? Well, basically, it's when short-term interest rates are higher than long-term interest rates. And if we think about it, it actually makes sense that this would be a problem, specifically for banks. So banks generally borrow money at short-term interest rates, and then they loan that money out at long-term interest rates. Well, if they were borrowing at a short-term rate that was higher than they could loan it at, well, that would lead to an unprofitable transaction. Unprofitable transactions are likely to lead to the bank not lending money. Banks don't lend money. Generally, that spells trouble for an economy. So in the last inverted yield curve video that I did, that one was at the end of March of this year. Well, this is what the yield curve looked like. And as we could see, it is inverted. We know it's inverted because the 3-month Treasury bills are actually higher than the 10-year Treasury bills. And at that time, it was only 2 basis points higher, but negative nonetheless. We say it's negative because if you take the 10-year Treasury bill and you subtract the 3-month Treasury bill, you'll end up with a negative number. If it is inverted and a positive number, if it's a normal yield curve. So this chart here, this chart starts at the beginning of 2019, and it's showing us the spread between 10-year Treasuries and 3-month Treasuries. So basically, if you get to this peak right here, well, this peak, that 32, is 32 basis points higher. So what that means is that right now, at that peak, the 10-year Treasury is trading 32 basis points more than the 3-month Treasury is paying. But then the spread begins to fall, and back on March 22nd, the yield curve inverted. And we know this because that number is a negative number. And a few days later, right here on the 27th, well, that's when I published the yield curve video that I keep referring to. Basically, I was talking about the fact that this could be a problem for the economy because it's negative, and it's been negative for at least a few days at that point. Now, one key point that I brought out in that video was that although there's not a hard and fast rule regarding this, generally it's accepted that the yield curve should stay inverted for at least 10 days before it's considered a very strong or powerful sign. And I bring this out because just a few days later, well, the yield curve started to improve and it no longer was inverted just 2 days after I had done the video. And by the time we got into early April, well, the excitement about the yield curve had mostly died down and less people were talking about it. But now let's switch over to what the actual yield curve looked like at the beginning of May from this year. So as we could see, well, the yield curve was mostly normal. Sure, the 2 and the 5-year notes are a bit lower, but economists tend to focus on the spread either between 3-month and 10-year or 2-year and 10-year. Now, technically, the 2-year and 10-year is actually the stronger of the two, but the 3-month and 10-year is well documented as well. And then in the middle of last month, well, the yield curve once again inverted. And now we're going to begin our day count. And interestingly, it only stayed there for 1 day this time. But a week or so goes by, and once again, it inverts. Except this time, it stays inverted, and our day count continues to rise. So now, as you can see, we've now passed that loosely defined 10-day marker, and it's continued to push higher up until today. Okay, so now what? Well, if you happen to see the more in-depth video that we did on the inverted yield curve, well, you may remember that one of the issues with the inverted yield curve is timing. So sometimes when the yield curve inverts, as it is right now, well, that may lead to a recession in the next few months or the next few quarters. Or perhaps it leads to a recession in the next handful of quarters or the next couple of years. Timing is an issue. That's one of the problems with the yield curve. Now, in my mind, this gives me at least some idea of what the Federal Reserve might have been thinking about when they float out the idea of lowering interest rates. So the Federal Reserve, when they lower interest rates, they don't directly impact any one of these rates. Essentially, what they can do is they reduce super short-term rates, overnight rates, and that in theory should have a bigger impact on 3-month rates. So if they see the yield curve inverting like this, and I'm sure that they do, well, it would make sense for them to try to drag down the 3-month rates, and hopefully the market plays along and they could try to flip this whole thing to be more positive. And then perhaps they're able to incite enough growth in the economy to keep things moving forward, and perhaps that staves off a recession, at least in the short run. Now, this could possibly explain why we might get an inverted yield curve and not a recession afterwards. Clearly, though, the inverted yield curve isn't the only thing that they're looking at and the only thing we should consider. So what should we do as investors? Well, for me, this is a big deal. And this is the strongest sign I've seen of the possibility of a recession coming around the corner. Sure, it's felt like a recession should come since we've had such an amazing bull run for so long. I think we just passed a 10-year mark, which ties it for the second longest one in history. But sure, there's been signs before this, but none of them as clear and distinct as this for me. Now, I still don't believe that sitting on the sidelines makes a lot of sense when it comes to investing. But full disclosure, that's really just the way I think about things. It's how I'm sort of built when it comes to investing. It's my attitude towards it in general, which is mostly tied to my personal level of risk tolerance, which frankly is quite high. I don't mind putting money to work today and having the stock market tank tomorrow, and then I can watch it recover. I can gradually get it to recover in the years that follow. But now that's not to say that I think it's smart to act the same no matter what we think the economy is doing. Personally, I think it's time to be defensive right now, and I think it makes sense to shift our portfolios into more defensive holdings out of more speculative holdings, assuming we have the ability or the willingness to sell some names and buy some others. How defensive is really the question. That being said, I actually did a video at the beginning of March called Should I Invest Now or Wait for a Market Crash? And in that video, I walked through a few different leading economic indicators. The inverted yield curve was one of them at the time. Well, I got a lot of requests to do that more continuously, at least on a quarterly basis. And right now we happen to be at the quarter mark. So I expect to be publishing that over the next week or two. And I think that should give us a better idea as to, let's say, a broader picture of the overall economy on top of just the inverted yield curve. For now, I think it makes sense to stay defensive, but keep watching this because this could end up being a big deal. And then if we can look at the other economic indicators, perhaps we can get a better idea. That way, we're not blindsided if something big happens. And if we've been watching it, I think we'll do a better job of forecasting what could possibly come. So my question for you is, what do you think is going to happen to the stock market over the next year? 1 year from today, where will it be? up, down, or sideways? Let me know what you think in the comments below. And if you haven't done so yet, hit the subscribe button because I got a handful of good videos, including the economic indicators, invest now or wait until later video. I got a few planned over the next couple weeks. So if you haven't done so yet, hit the thumbs up. Thank you for sticking with me all the way to the end of the video, and I'll see you in the next video.